We've always been taught that the best time to invest is after a market crash when valuations are low, and yet when a crash actually occurs, very few investors typically have the courage to take action and will say things like, this time is different, or we've not hit the bottom yet, when in reality we've seen this happen many times in the past. It's not possible to time the market, but good assets always eventually recover and richly reward those who invest during times of market crisis. Therefore, if you think rationally, you should start investing when valuations are low and maintain a long-term outlook. This brings me to real estate investment trusts, or REITs in short. I think that they are today offering a once-in-a-decade opportunity to win big in the coming years, and yet few investors seem to be paying attention. And I know that the phrase once-in-a-decade opportunity gets overused, but the thing is that REITs are priced today at their lowest valuations in 16 years after the recent crash that they suffered. And best of all, I think that the reason why they are discounted is only temporary. The surge in interest rates caused a lot of investors to sell REITs, irrespective of their fundamentals, to reinvest these proceeds into bonds and treasuries, and this caused REITs to crash. But interest rates are now expected to be cut in the near term, and therefore I expect many of these same investors who left REITs to rush right back as they realize that the income that they were expecting from fixed income investments weren't sustainable after all. The debt market is today pricing roughly 125 basis point lower interest rates within a year from now, and some other central banks around the world, including in Canada and Europe, have already started to cut their interest rates. And I think that this should be a very strong catalyst for REITs because, again, they crashed due to interest rate hikes, and therefore logically they should also recover as interest rates are cut. And it gets even better. Right as interest rates are cut, we also expect the rent growth in many property sectors, including industrial and residential, to accelerate because the recent surge in interest rates and inflation has put most new construction projects on halt. Therefore, all the recent bad news could soon turn to an avalanche of good news as the focus shifts from rising interest rates to rate cuts coupled with accelerating rent growth. The valuations of some REITs could rise by over 50% as they recover closer to historic norms and while you wait to earn significant dividend income. That is why I truly think that this is a once-in-a-decade opportunity, and I'm personally heavily investing in REITs today. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to highlight 3 once-in-a-decade REIT buying opportunities. But before I get into it, could you please do me a huge favor and click the like button if you think that this content is valuable? I'm putting a lot of work to produce all this free content for you, and it will help me a lot to keep growing this channel. Thanks so much in advance. So the first REIT I'm going to discuss here is called BSR REIT, and this is my biggest apartment REIT investment. I'm about to give you an overview of my investment thesis as of July 2024. But before that, I want to let you know that our analyst Samuel Smith just recently had an exclusive interview with the company's CEO as well as its COO, and he's going to publish a video summary of this interview for his YouTube channel. So I highly recommend that you go subscribe. I'll put a link to it in the description of this video. Again, this is one of my biggest REIT investments today, so you don't want to miss this out. Overall, I'm bullish on most apartment REITs today, and this includes Mid-America Apartment Communities, Camden Property Trust, Independence Realty Trust, Avalon Bay Communities, and many others, but BSR stands out in its peer group in 5 ways. Firstly, nearly all of its properties are located in rapidly growing Texan markets that are expected to experience significant population and job growth over the coming decade. Secondly, it focuses primarily on Class B garden-style apartment communities with an average rent of just around $1,500 per month, which makes them recession-resistant, and they're also less affected by the new supply. Thirdly, the rent-to-income ratios in BSR's market are a lot lower than in popular gateway markets. They're today about 20% in BSR's market versus 35% in gateway markets, and this provides strong margin of safety, but also significant upside potential as these Texan markets like Houston, Dallas, Austin become increasingly popular over the long run. Fourth, the management is the biggest investor in the company, so they're truly looking out for the best interest of shareholders. They're today very aggressively buying back shares to take advantage of their discounted valuation. And then fifth, despite enjoying some of the best growth prospects in its peer group, it's actually priced at one of the lowest valuations at just around 12 times FFO and a 35% discount to its net asset value. This means that just to return to its NAV, the company's share price would need to rise from 50% from today's level, and the company was actually priced at a 10% premium to its NAV prior to this recent crash, so this seems quite realistic. In our recent interview with the management, our analyst Samuel asked about their valuation and what they think of it, and they answered that right now at $11.50 per share, I think you're buying BSR at around $135,000 a unit. I haven't seen $135,000 a unit for what we own in my career ever. Meanwhile, 8 of the top 10 fastest growing counties in the United States are located in Texas. DFW and Houston lead the nation in numeric population growth. Today, the cost to build apartment communities is closer to double of that, to getting a deep discount relative to replacement costs in rapidly growing markets. Then we also asked the management if they would be willing to sell out the entire company to unlock value for shareholders. And again, I highly recommend you go check out that interview to learn more. There's a link in the description. But essentially, they said that they would be willing to sell out to a company like Blackstone or KKR if that made sense for shareholders. And, as a reminder, Blackstone has bought out 2 residential REITs already this year, Tricon as well as Apartment Income REIT. We profited from both transactions at High Yield Landlord. Now, just recently, KKR also announced its biggest apartment acquisition ever. It's buying a $2 billion portfolio from Leonard. So clearly there's a lot of interest for these assets in today's market. I would add that KKR is paying over $400,000 a unit for the portfolio from Leonard, and whereas BSR is trading at less than half of that, and clearly the portfolios are not 100% comparable, but still it gives you a sense of the margin of safety that's built into today's valuation. The growth prospects are limited in the near term because Texas and other Sunbelt markets are facing some oversupply. But even in this tough environment, BSR has guided to grow its same property NOI by about 2% this year. And this growth should accelerate in 2025, 2026. Even as interest rates are cut, I think that this will be a strong catalyst that will lead to significant upside unless the company is bought out prior to that. And so that's the investment thesis in a nutshell. You get to buy high quality Texan apartment communities at 65 cents on a dollar. The management is very well aligned with shareholders. The debt is reasonable with a roughly 40-45% LTV. And so I really like the risk to reward at these valuations. Once more, to learn more about this opportunity, make sure to subscribe to the YouTube channel of Samuel Smith to not miss our interview video. I'll put a link to it in the description of this video. Then the second REIT I'm going to discuss is called REXford Industrial Trust, which is an industrial REIT. And again, here I think that pretty much the entire industrial REIT property group has recently become opportunistic. I'm also bullish on companies like Prologis, First Industrial, East Group Properties, and many others because these tier 1 industrial REITs have recently become opportunistic due to 3 key reasons. Firstly, their share prices have crashed even as they significantly expanded their cash flow, and therefore they are even cheaper than it may seem. Most of them are priced at a 20-30% discount to its NAV and just around 18 times FFO, which is historically low for these rapidly growing REITs. Secondly, they enjoy a huge mark-to-market in their leases, and therefore as their leases now gradually expire, we can expect significant rent bumps in the near term. And then thirdly, many of these REITs own a lot of land or underutilized assets, which should allow them to significantly expand cash flow in the near term as they redevelop their current assets or develop new properties. And I think that REXford stands out in this industrial peer group today because it has one of the least leverage, it's one of the biggest in size, it focuses mostly on markets that have less risk of oversupply, it also isn't as heavily exposed to ground-up development risk, and finally I think that its organic growth prospects are some of the most predictable in its peer group. And this is really because of Rexford's unique focus. It's 100% invested in infill locations in SoCal, and this is really the strongest markets for industrial properties in the entire nation. I'll put a picture on the screen of a typical property of Rexford, and you'll see here that it's almost impossible to bring new supply into these markets, and yet the demand keeps on growing, and this is why these properties have done so well over the long run. The demand is growing because of the growth of e-commerce, the growing trend of nearshoring and onshoring, the broader GDP growth, as well as the strategic location of the West Coast for import and export businesses. As a result, SoCal today has the lowest vacancy rate for industrial properties at just around 3%. Even as we are talking about oversupply, really these markets are not heavily impacted, again, because there is simply no land to build more. And Rexford is today enjoying a 45% mark-to-market in its leases. This mark-to-market, coupled with some other additional investments, is expected to result in 47% growth over the next 3 years alone, and this won't even exhaust the entire mark-to-market that Rexford today enjoys. I think that other industrial REITs enjoy quite similar strong growth prospects over the coming years, but I would argue that those of Rexford are even more predictable, again, because of the unique nature of its markets being supply constrained. And despite that, it's actually priced at one of the lowest valuations in its peer group today at around 18.5 times FFO and a 25% discount to its NAV. Here, I'm sure some of you will think that 18 times FFO doesn't sound that low, especially if you're comparing that multiple to that of, I don't know, EPRA Properties, which is trading at closer to 8 times FFO. But here you need to keep in mind again that it has a massive mark to market in its leases. So this 18.5 times is based on today's lower rents, but as the leases now gradually expire in the coming years, we're going to see its cash flow increase very significantly. So already just 3 years from now, this multiple will be in the low tens unless its share price rises to higher levels. And the same applies to the dividend here. The current yield is 3.5%, which may not seem like much, but the dividend has been growing at 18% per year over the past many years, which is the fastest dividend growth rate that I know of in the entire REIT sector. And this means that already next year on a forward basis, the dividend yield is actually closer to 4%. If it keeps growing at this pace, the dividend yield will soon already exceed 5 or even 6%. And so that's very high for such a rapidly growing REIT. I think that as this growth materializes and interest rates are cut at the same time, the share price of REXford is going to rise very significantly, because otherwise it would start trading at a valuation that just makes no sense for a REIT of this quality. And then the third REIT is SBA Communications, ticker symbol SBAC. This is one of our newest investments at High Yield Landlord. By the way, if you want to access our entire portfolio, you can join us for a 2-week free trial. I'll put a link to it in the description of this video. But we invest in SBA Communications as part of our core portfolio. We currently already own an investment in Crown Castle, which is one of its cell tower peers, as part of our retirement portfolio. We think that both REITs are very attractive. We actually also even bullish on American Tower, which is the third cell tower REIT, but we think that SBA Communications is arguably the best pick for investors who have a higher risk tolerance and are looking to maximize their total returns, because it's the smallest in size, it uses the most leverage, and it invests in riskier foreign markets, which have historically resulted in very significant outperformance. I'll put a chart on the screen. You'll see there that all three cell tower REITs have done exceptionally well over the long run, but SBAC has done far better even than its close peers. But despite that, it's actually one of the cheap in its peer group. Its share price has crashed by about 50%, even as its cash flow has increased very significantly. And as a result, it now trades at just around 1/3 of where it was 2 years ago. It's priced at about 14.5 times FFO. At its peak, it was at about 35 times FFO. And the interesting thing here is that even at the lowest point of the pandemic, it was trading at still at 23 times FFO. And so you truly get to buy it at a decade low valuation today at around 14.5 times. I agree that SBA was probably a bit pricey. It was overpriced in 2020, 2021 when interest rates were at near zero, but I also think that it's today heavily undervalued because of the recent fears of rising interest rates. The market essentially went from one extreme to another, and this has provided us now a rare opportunity to buy an exceptional REIT at a heavily discounted valuation. In fact, the valuation has become so low that for the first time in a very long time, SBA is now even buying back shares of the company. In the last quarter alone, they bought back about 200 million worth of shares at $213 per share on average, and yet today it's even cheaper, trading at below $200 per share. And so here you may ask yourself, why has this company suddenly become so cheap? Why has it crashed by so much? And well, the first reason, I've discussed it already, is the surge in interest rate, but there's another reason why cell tower REITs have recently crashed, and it's T-Mobile's recent acquisition of Sprint, which is leading to some tenant consolidation, some lease cancellations, and this is hurting its near-term growth prospects. It's also true for American Tower and Crown Castle. So the growth is a bit limited in the near term, but even despite this headwind, SBA is expected to keep on growing. Currently, based on the consensus analyst estimate, is expected to grow its FFO per share by 16% by the end of 2028, which, yes, it's a lower growth rate than in the past, but it's still a very respectable growth rate for a REIT that's priced at such a low valuation. And keep in mind that the company could end up growing quite a bit faster if you now account for the expected interest rate cuts in the near term. SBA likely crashed a bit more than its close peers because it runs on a bit more leverage. Today its debt to EBITDA is about 6.5 times, but that's quite reasonable actually for a REIT that's enjoying such growth prospects and it's retaining so much capital. SBA is unique in that its payout ratio is only about 35%. So yes, its dividend yield is very low at about 2%, but that's simply because it's retaining all of its cash flow to deleverage its balance sheet and to buy back stock. So in short here, I think the market has overreacted to near-term headwinds and forgotten about the long-term growth outlook. Its price to FFO is the lowest since the great financial crisis, and its price to NAV is also now very low. It's trading at over a 30% discount to its NAV. That's a far lower valuation relative to NAV than American Tower and Crown Castle. Simply returning to its NAV and a more reasonable price to FFO could unlock about 50% upside from here, and I think that we are quite likely to see this happen now as interest rates are cut in the near term and the company's growth accelerates past 2026, which is when it won't be as heavily impacted by the lease cancellations anymore. Finally, the company just recently hiked its dividend by 15%, and I expect this rapid growth to continue going forward, given that, again, the company has a very low payout ratio and it has strong long-term growth prospects, and I think that this is another catalyst for the stock. So to conclude here, REITs are today priced at the lowest valuations in a decade, but I think that the window of opportunity could be closing pretty soon because they now enjoy powerful catalysts in the near term. For one, interest rates are expected to be cut quite significantly in the near term, but on top of that, rent growth is also expected to accelerate, and these two elements combined together could push a lot of REITs to a lot higher levels. Now, if you want to access my entire real money REIT portfolio, you can join High Yield Landlord for a 2-week free trial. This is my REIT newsletter where I share all my transactions in real time, as well as my real money REIT portfolio. We also there have a course to REIT investing and many other interesting resources. Again, this is a real free 2-week free trial. You won't be charged anything in the first 14 days. You can join just to check it out. If it's not for you, you cancel. You won't be charged a penny. And if you then decide to stick with us for the long run, you'll enjoy a large discount as part of an annual subscription. Let me know if you have some questions in the comment section below, and then finally, if you could please click the like button and subscribe to the channel. That will help me a lot to keep producing this type of content for free on this YouTube channel. Thanks so much in advance. See you at my next one. Bye bye.